Hey, this is Travis, and I'm back with part 2 of my cover call training. In the first part that you see here on the screen, the title is Market Club Plus Cover Calls, How to Place a Cover Call Trade. What I did was show a live cover call trade and walk through the mechanics of how a cover call trade. It wasn't like a deep dive into the subject, but at least showed you, how easy it is. It's actually the oldest and simplest option trading strategy available. Now, and today, though, what I want to do is talk about the downfalls of cover calls, because in that video, and so in that training, you saw me make an instant, easy, effortless, and guaranteed. No, you saw me did, but it is. The money shows up instantly when you place a trade, and it has a gratification, appealingness to it. Like, you get instant cash. You click buttons and cash shows up in your account. And when you're trading with hundreds of thousands of dollars or millions of dollars, sometimes $20,000 can show up in your account instantly. And so a lot of people like that. It's something to look forward to in the future. But when you're starting out, you have a small account. And so I show people, hey, with a small account, you start out small. And the thing I always teach Success Academy members is don't focus on the dollar amount. You focus on the $68 you received, and it's kind of depressing. You're like, oh, I'm never getting ahead. But if you look at the percent return, it was a 3% return in a week, right? And so that could be, 12% a month on your money if you were able to duplicate that. And this is what cover call marketers will sell you on. They're like, hey, you can make 2 to 5% on your money each month, 60% a year. Those returns are outrageous, right? Where have you heard anybody can get that when the general market earns 7 to 9% a year? So of course people are attracted to that, but they don't cover the downfalls of cover calls. You discover that after you buy their product, right? So I wanted to kind of touch on that in today's video. But yes, the cover call trade made a 3% return. And so now I want to talk about the downfalls. So one of the downfalls of cover call trading is that the marketers won't tell you is that, and you won't discover this unless you've done testing like me, is that a simple buy and hold strategy, and I'm talking about like buy and forget, a simple buy and hold strategy often makes more than cover call trading, more than the cover call marketers will tell you. And so once I discovered that with real world results, I compared my trading results to my wife's account. As a matter of fact, we had 2 accounts of roughly around the same amount. And here I am doing trading, cover calls, all this other stuff. And her buy and hold account had beat mine. And it was humbling. I'm like, wow, I'm sitting here singing all the benefits of trading like it's the best thing since, peanut butter and jelly, right? Or sun butter and jelly for my son who has peanut allergies, right? But I realized that, wow, buy and hold actually beat my trading account. And that is when I started making the shift from a trader to an investor who uses options. So now I'm mostly an investor who supplements my performance with options. And I'll kind of talk about how I solve one of these cover call downfalls here in a second. All right, so that's downfall number 1, is that a simple buy and hold strategy can often make more than cover call trading. I just realized I said downfall number 1, but now I'm thinking about it. I'm like, well, that's actually the only downfall I had on my notes was that buy and hold can actually make more. And the second downfall, I guess, per se, is what I was thinking, is that the stock could run away from me. But that's what I mean by downfall. So let me just go ahead and actually show you here. All right, so again, I made a 3% return on my money in a week with the cover call trade. Here, and before I show you the downfall, I will say the one good thing about this is that why people love cover calls, and I do trade cover calls. I don't think there's anything wrong with them. There's ways around the downfalls, which I'll cover, but it gives you control over how much money you can make. Like, we pay for our cruises. I pay for my wife's Mother's Day gift, the kayak, if you saw that case study on YouTube. I pay for her Mother's Day gift with cover calls. So they have a usefulness, like, hey, I have a target income I want to earn. Well, you buy and hold, you can't target an income. You just have to kind of take whatever buy and hold gives you. But with cover calls, you can target an income. Hey, I want to make X% each month, and then you can structure a cover call trade to do that. That's the beauty of it. But again, here's the downfall. I went ahead and mapped out here the same time frame my cover call trade. So I bought this stock at 906. If I was a buy and hold investor, I bought it at 906. On 626, when my cover call was assigned, assignment means without getting too deep into the mechanics of it, when you sell a cover call, you're like renting out your stock. It's like rent to own. You're telling somebody, hey, you can take my stock away from me at a set price. In exchange for that, they give you premium. It's like rent a lease purchase on a home, right? So my stock was assigned. The person decided to, hey, buy my stock from me for $9. And why is that? Well, they're smart, because on 626, Zynga was trading at $9.58. So they got a discount because I sold that cover call. Well, we both, is a win-win for all of us. I got the premium I wanted, the 3% return I was targeting, right? They got a chance to buy stock at a discount. The stock was trading at $9.58 on 626. So they had a right to buy it at 9. Who wouldn't take that up, right? So yeah, they exercised their right and bought the stock for $9. And so I just wanted to show you here, if I had simply bought the stock, simple buy and hold, and then sold it, like maybe a short-term swing trade or something like that, I would have actually made 5.74% in a week with buy and hold. So that's the downfall there. I would have made more with buy and hold than with the cover call. And again, most cover call marketers won't tell you that. But again, it's not really a bad thing. It's because you can target your income with cover calls. I could target that 3%. This was speculative. I didn't know if I would earn 5%. So it's kind of like a gamble. You don't know, and that's the downfall. But again, the times it works out is where you can make more with buy and hold. And if I was still holding on to the stock is actually trading at $9.70 right now. And I missed out on that. So that all that run from $9 to $9.70, where it's at now, I missed out on because of the cover call. So that ties into that downfall. You miss out on that buy and hold of growth, that capital gain, because your stock was taken away from you. But if you had just bought the stock here and held on to it, you would have been making more money with the buy and hold strategy. So I just wanted to cover that downfall. Now, there are some ways around that downfall, which we teach in the Success Academy, which I will just cover here as a big picture before I let you go. There is a technique called rolling options. And so let's say we sold let's say it was still that $9 cover call, right? And let's say it was this one. It's in the money, which means that most likely I would have to sell my stock. Again, who wouldn't buy a stock for $9 when it's trading at $9.70? So what someone does is they buy this back for 70 cents. They will most likely buy it back at a loss, and then they roll that out further in time, maybe from 4 days out, and they change it to like a 46-day trade. And then they sell one a little higher up, maybe at 10 or 9. Basically, they're just adjusting their trade, trying to avoid having it get called away. So that's not something I really sign off on. I do it occasionally, but I only sell cover calls on stocks I actually don't mind selling. So it's like, I want the income. I don't care if I get called away. It's a win-win for me, right? In the Success Academy, another way around it is what we call a Buffett call option, which we won't have time to get into. That's a longer training. But basically, the Buffett call option captures any growth you miss out on, any long-term growth you miss out on. So you can still get the cover call income and the capital gain. So it's a way to get the best of both worlds. Third way you can manage this is just to close it for a loss. If I wanted to actually buy this cover call back on 626 before I got assigned, I could have done that, but I would have had to take a loss. And I didn't want to take the loss. I wanted the income. So I definitely don't do that. I'm like, why give back that income? That's what I wanted. I wanted the income, the $68. So if I buy it back for a loss, I actually give up the $68. And I don't want to do that. So, yeah, that's not something I do. That's just intentionally taking a loss is just dumb, in my opinion. I always tell people you don't get rich by intentionally taking losses. You get rich by making money. That's just my biased opinion. But anyway, all right, last one way I found around this and what I said I transitioned to an investor who supplements my portfolio with options is I am a long-term buy and hold investor at my core. 80 to 90% of my money goes towards long-term buy and hold investing. All right, a lot of people don't know that, but Success Academy members do, of course. But then what I do is if the stock happens, because I want the buy and hold growth, because I've discovered that I can make more money with buy and hold. So Zynga is not the stock I usually trade, but if it was, I would trade Zynga. And then when Zynga has moments where it's trading flat like this or it falls in price, and what I would use is the same tool I use to get in a trade. And again, if you watch the first video, I walk through this tool and how I use it to potentially place covered calls. So I would wait till like a market club weekly or maybe a monthly or something like that. Then I would sell covered calls. Now, the beauty of why I do that, of course, I can't get into this short video, but the summary is that I get to keep the stock, and if the stock falls, yes, most likely my cover call won't be assigned. So I keep the stock and I keep my cover call premium. So that is some of the ways around the downfalls of cover calls. I hope you found this video enlightful. I hope you found some value in this video, and I will link to the first portion of this training if you have not watched that yet. So that is all I have for you. If you like this video, go ahead and hit that thumbs up button. If you did not like it, hit the thumbs down twice and let me know how much you really didn't like it. And as always, if you want to learn more about trading in the market, how average investors can often beat buy and hold with options, go ahead and hit that subscribe button. You take care, and I'll talk to you soon. Bye-bye.